Welcome to Analytical Methods 1. Let's get started. Alpha and beta. Beta is a measurement of a stock or a portfolio's variability as compared to the market as a whole. The market as a whole is the S&P 500. You need to feel comfortable with what a beta of 1 means. So when a beta equals 1, then the stock or the portfolio will move with the market. So if the S&P 500 is up 10%, you've purchased a stock that has a beta of 1, you should expect your stock to be up how much? Yes, 10%. So beta of 1 means it moves with the market. The higher the beta, the higher the risk. The higher the beta, the higher the risk. Beta is also sometimes called the beta coefficient. I'd like to give you some examples here. Tesla has a beta of 2.9. Do you think that Tesla is on the safe side of the risk spectrum or on the risky side? Yes, it's risky. The higher the beta, the higher the risk. So if it moved with the market, it would have a beta of 1. What would you expect an S&P 500 index fund to have for their beta? 1, yes. It moves with the market. An index fund, S&P 500 index fund, mirrors the S&P 500. So it would have a beta of 1. Ford. Now when I say Ford, what do you think? Do you think risky like Tesla? Do you think moves with the market like the S&P 500? You can kind of guess. Ford's beta is 1.28, so slightly more variable than the market as a whole. Another one I looked up just for fun, Berkshire Hathaway. If you don't know who Berkshire Hathaway is or what it is, it's Warren Buffett's company. Class A shares have a beta of 0.87. So what does that tell you? Not as variable as the market. So a beta of greater than 1 moves more than the market. A beta of less than 1, it doesn't move as much as the market. If an investment has a negative beta, the rate of return will be the opposite as that of the market as a whole. Alpha is totally different. So beta measures the stock's variability related to the market as a whole. Alpha is the rate of return that is in excess of that which is predicted by an equilibrium model. Maybe you've heard the term chasing alpha. Positive alpha is good. So we want positive alpha. So if the equilibrium model predicted that this portfolio of securities should earn, let's say, 7%, but it earned 9%. So if the prediction was 7%, but the actual earnings were 9%, then there would be a positive 2 alpha. And yes, that would make you, if you were managing the money, very happy. You'd probably earn a bonus. If the prediction was 7% and the actual earnings were only 5%, then you would have negative 2 for your alpha, and you might want to look for a different job. So positive alpha is always desirable. Financial ratios. Fundamental analysts, qualitative analysts use financial information in deciding which stocks to invest in, which securities look good to them. You do need to know what the ratios are, how they're used, and this idea that ratios are best for comparison purposes. When you look at a company's financial statements, and let's say you see how much they have in cash, and then you look at another company and see how much they have in cash, and of course, they have much less than cash. You can't really tell anything unless you compare it to something else and create a ratio. A very common ratio that fundamental analysts will look at is called the current ratio. The current ratio is going to take current assets and divide by, so I'm making a fraction, current liabilities. Current assets divided by current liabilities. The higher the ratio, the more liquid the company is. So the higher ratio, the better. So it's a measurement of liquidity. Remember, current assets are cash and expected to be cash in the next 12 months. Current liabilities are monies that are owed in the next 12 months. So how much more in assets does a company have than it has in liabilities? The current ratio is what you would look at to compare companies in this area. The quick ratio is also called the acid test ratio. So feel comfortable with either term. It's similar to the current ratio. You start off with current assets, but out of current assets, you're going to subtract the company's inventory. The reason behind that is the inventory doesn't always sell as quickly as the company would like, thus the term quick ratio. So current assets minus inventory divided by current liabilities gives you the company's quick ratio. It is the most stringent measurement of liquidity. Most stringent measurement of liquidity. The quick ratio. Generally on the test, it's not what is it, it's how do you determine it. Current assets minus liability divided by current assets minus inventory, if I can say that correctly, divided by current liabilities. That is the quick ratio, the acid test ratio. The other one you need to feel comfortable with is the company's debt to equity ratio. Debt to equity. The debt to equity ratio compares a company's long-term debt to overall capitalization. It is a measurement of leverage. Leverage is debt financing. So when a company sells bonds, they engage in leverage financing. So for example, to say that the company has 50 million in stock and 100 million in debt, their total capitalization would be, so 50 million in stock, 100 million in debt. Their total capitalization would be 150 million. The debt is 100 million. So debt to equity ratio, 100 million divided by 150 million. 66.7% would be the debt to equity ratio, a measurement of leverage. Remember, the denominator is not only the equity, it also includes the debt. It's the total capitalization of the company. So don't get tricked there. Working capital is also a measurement of liquidity. Different than the current ratio, however, working capital is a dollar amount, so not good for comparison purposes. You do need to know what the formula is for working capital. Current assets minus current liabilities. Working capital, dollar amount. Of course, you want current assets to be more than current liabilities. It is a measurement of the short-term health of a company. How likely could they withstand a short-term economic contraction? If you want to look at one company to another company, you want to look at what again? Not working capital as a dollar amount. You want to look at the current ratio. Better to compare. Use the current ratio. Valuation ratios are used to compare stocks within the same industry only. You can't take the price-earnings ratio of Google and compare it to Ford. There is no comparison. They're not in the same industry. Valuation ratios help an analyst determine if a stock is overpriced, underpriced, or priced just right. The ones that we have to feel comfortable with are price, earnings, and price to book ratio. Let me ask you, where does a company's earnings per share show up? Where? Balance sheet, income statement? Income statement. Earnings per share are found on the company's income statement. The price-earnings ratio is found by dividing the stock's current market price by earnings per share. This gives you the company's price-earnings ratio. Earnings per share from the income statement. To find a company's earnings per share, you're looking at the earnings available after preferred stocks dividends have been paid. So after you pay preferred stocks dividends, you have this number, earnings available for common. The company could choose to pay out all of those earnings in the form of dividends to the shareholders. Generally, they don't, but they could. So it's that number after preferred stocks dividends have been paid, earnings available for common, divided by number of shares of common stock outstanding. That will give you earnings per share. I'll give you a few examples. If an industry's average PE ratio is 40, so let's say the average is 40, and this stock is trading at 45 times earnings per share, what is this stock? If the average is 40 times earnings per share and this stock is at 45, is it overpriced, underpriced, or priced just right? It would be overpriced. If instead its PE ratio was 35 times earnings, the average in its industry was 40, then this one would represent a good buy. It would be underpriced. So that's how the fundamental analyst will use the price-earnings ratio. Let me ask, who has a higher price-earnings ratio? Blue chip stocks or growth? Blue chips or growth? Who has the higher price earnings? Growth. Growth stock has higher price earnings ratios. Let me give you some real world examples. The auto industry average, of course this is for, a moment in time. You can't say in a year from now these numbers are going to be the same thing. The auto industry's PE average is 15.71, so they always do time. So the market price of the average auto industry stock is 15.71 times the company's earnings per share. Tesla, what do you think? Do you think they're going to be in the blue chip category or in the growth category? What do you think? Definitely in the growth. Their price earnings ratio is 129.12 times earnings per share. So overpriced relative to the auto industry? Sure, definitely. Doesn't mean it's not a super popular stock. Ford, do you think Ford's PE ratio is going to be higher or lower than Tesla's? Definitely lower. But even it's 47.68 as of the moment in time, is higher than the industry average. So I think it's always fun to take these concepts and look at them in the real world. So now you can go and look at a stock quote, because stock quotes will tell you the PE ratio. In the real world, you don't have to go look at an income statement, figure out earnings per share, and then get your own PE ratio. It's done for you. However, it's always on the test. What do you plug in to figure out these numbers? You definitely have to know. Price to book ratio. The test loves that value stocks have low price to book ratios. It is the defining characteristic on the test for value stocks. Price to book. So let me give you an example here. Citi is a value stock. Their current market price is 65.37. Their book value per share. So if the company was liquidated, what is on the balance sheet, what represents the owner's equity per share is 84.48. So think about that for a second. If the current market price is less than its book value per share, it sounds like a value stock. It's undervalued. So you take the current market price divided by book value per share, and Citi's price to book ratio is 0.77, characteristic of a value stock. Income measurements. Current yield on common stock. Definitely a formula you have to know. This is not a math test. I've been teaching these classes for a very long time. Historically, when I first started, this was a math test. You had 30% of your questions that were math questions, and if you hated math, this test was really hard. The test is still hard, but not because of math. It's hard for different reasons these days. So if you hate math, just know at most, I'm going to say 5 math questions. 1 math question you always have is current yield. As far as what is the question in this area of the exam, it's not a math question. It's a do you understand current yields and how does it apply to growth stocks and blue chips and that kind of conceptual question. So current yield on a stock is annual dividends. So the dividends are the yield, and then the denominator is current market price. So annual dividends divided by current market price. If we were talking about current yield on a bond, it would be annual income, which is not dividends because bonds pay interest. So annual interest divided by current market price would be current yield on a bond. Current yield on a stock, annual dividends divided by current market price. So current yield is the past dividends divided by the current market price and is not a promise of what will be paid in the future. Dividends are paid at the discretion of the board of directors. They are never guaranteed. Where interest on a bond is guaranteed to be paid, unless the company goes broke or something crazy like that, dividends are paid at the discretion of the board of directors. However, if your client is looking for income, let me give you an example of the test question. Your client is looking for income. I'll give you some choices. Growth stock, blue chips. Now, it's never going to be, what company is a growth stock, what company is a blue chip, but just for fun, I'm going to bring some of the real world into here. So blue chips, IBM, Coca-Cola, JP Morgan, Johnson & Johnson. And then growth stock, Tesla, Google, Amazon. Where would your client be more likely to find yield? Yield, blue chips. More likely to pay dividends. Remember, growth stock have low to no earnings. They pay low to no dividends. JP Morgan's current yield is 3%. Johnson & Johnson's is 2.6%. So if your investor is looking for income, not a guarantee of income, but if they're looking for income, blue chips always win over growth. Tesla, Google, and Amazon, none of them have ever paid a dividend. When your client buys growth stock, why are they buying growth stock? Because they're looking for appreciation. They want to buy low and sell high. And if you'd bought any of those stocks when they were new and you still own them, you have a great deal of unrealized appreciation in your portfolio. No current yield, however. No dividends have been paid on any of those three. Certainly some growth stocks may pay a little bit, but as a general rule, we're going to say no dividends. Earnings per share comes from we briefly talked about this when we did PE already, income statement. Earnings available to common, which is after preferred stocks dividends have been paid, divided by the number of shares of common stock outstanding. That is the formula for earnings per share. The dividend payout ratio, where do you think it's going to be higher? In a blue chip stock or in a growth stock or in a value stock? It's going to be the highest in a blue chip. Blue chips are going to have the highest dividend payout rate. So the dividend payout rate measures the proportion of earnings paid to stockholders as dividends. So let's say they had 100 million in earnings and they paid out 80 million of those earnings in the forms of dividends. That's an 80% dividend payout rate. JP Morgan's most recent dividend payout rate was 47%. So almost half of their earnings that they could have paid out to shareholders in the form of dividends, they chose to pay out to the shareholders in the form of dividends. That concludes our discussion for Analytical Methods 1. Be sure to take the topic quiz. You want to get to 90% or better. That gives you that little bit of freaking out, I'm taking a real test, so that you're sure to pass when you take it the very first time. I will see you in the next video.